Hello, everybody. You'll have the presentation? Great. Wow, on the big screen, it's very large. I'd like to thank Besnick and the Kosovo Credit Guarantee Fund for inviting me and including me in this conference. Having been involved with KCGF from before KCGF existed, it's really an honor to be here and see the success of the fund. I guess I have a clicker. Whoops. Okay, my staff, when they saw this as my first slide, thought I made a serious mistake, but I didn't. These numbers mean something. The 10 is for 10 years of success of the Kosovo Credit Guarantee Fund, which you've heard a lot about today. But 2026 represents a number of things with 10-year marks. For example, our Crimson non-bank financial institution in Albania is also 10 years old and fortunately very successful, and it has a partner here in the Albanian Development Guarantee Fund, which we're very glad to sign just, I think, week before last, which is a big advance. Also, Let's Dance for Mothers and Children, which is probably the biggest annual charity event in Kosovo, which supports the Action for Mothers and Children Foundation. This September is celebrating its 10th edition. It's a fun night of dancing and networking and eating and drinking, and all the money goes to support Action for Mothers and Children, so you're all invited. And an additional thing is that 10 years ago, the publishing of sales prices on real estate was included in the Kosovo real estate strategy. I'm very pleased that now sales prices of real estate are in fact publicly available and accessible, which leads me to a comment on the previous panel. If Kosovo can get sales prices of real estate to be made publicly available, I think you can have data available for doing credit risk analysis. So let's move it along. Let me know if you need help with changes for the law to do that. The 25 years this is my 25th anniversary of working in Kosovo. And it's a very big honor for me, and it's really my second home, so I appreciate being welcomed here for all these years and being able to work with many of you. The 50 this year is also my 50th wedding anniversary. So for those of you who actually had to put up with me for 25 years, imagine my poor wife that's put up with me for 50. So on Tuesday, sponsored by the European Association for Guarantee Institutions, the World Bank gave a presentation on their survey of 108 guarantee funds around the world. And this is just some summary points from that presentation. It was very enlightening and about some of the key parameters of guarantee funds. And I will mention some of those during my talk. But KCGF actually set out on this path, from 2015, and has adopted many of the things that the World Bank and IFC and EIB and et cetera present as hallmarks for what the key principles for a good guarantee fund is. And the Macedonia Credit Guarantee Fund is being launched this year, and we hope to follow in the footsteps of KCGF and also meet those key principles. Basically, the Montenegro Credit Guarantee Fund is learning from the experience of KCGF and, of course, other funds in Europe and around the world. Guy mentioned from the European Association of Guarantee Institutions that context is important. And in the World Bank, Pietro's talk on Tuesday, he mentioned that there are certain principles of guarantee funds, but you have to take into account the financial sector and the business and the economy and the size and scale of the given country to modify the guarantee fund to meet those. So we hope to do that also in Montenegro. We're well on our way. The law to create the fund, which has strong similarities to Kosovo, went into force in August. The board was appointed in just this February. I'm very happy that we have 5-member board, 3 are independent. Two of the three independent board members are with us today. Zoran Martinovsky from Macedonia was elected the chairman of the board, and Vjosa Kelmendi from KCGF is another member. The fund is expected to be very lean, like the way KCGF started, and grow over time and become self-sustaining on guarantee fees and income from invested capital. A question I've gotten in the time I've been back in Kosovo this time from people that know I'm going to talk about it is, yeah, well, what about the banks and the other financial institutions? At the very early stages of KCGF, of course, convincing the banks and educating the banks was a major part of the initiative. And all along the way, we've been meeting with and interacting with the financial institutions in Montenegro, and I'm very pleased to say that there's basically unanimous support from the banks and the other institutions for the guarantee fund. It helped that they heard about the Kosovo Credit Guarantee Fund and its success. Success breeds success. So they're confirmed. They, of course, want it to be independent, free from political interference, free of conflicts of interest, adequately capitalized, efficient. They didn't want duplicate procedures. But within those constraints, they're very supportive. In the case of Kosovo, there was a mix in the initial capital. Some came from the government, from the Ministry of Industry and Trade. Some came from USAID, some came from KfW, and then as things went by, additional sponsors have jumped on board, the World Bank, the EIB, and there have been also co-guarantors, CETA and the EU and USDFC have provided co-guarantees, and that's helped expand the activities. As I said, the law was approved, and it's going to be an independent agency, independent institution similar to Kosovo, and the board is the highest governing organ. The next steps, the board members have been appointed and are now active. We've had preliminary meetings. The first in-person meeting will be in Podgorica mid-May, and election of the board chair has been done, and that was Zoran. It turns out, bureaucracy matters, as you heard in the previous panel discussion. So we're working on getting our taxpayer identification number, opening the bank accounts, getting the money transferred from the government, except all those things which are in process and being done. The open recruitment for the CEO of the fund is ongoing now with a deadline April 30th. It will be for a Montenegrin CEO. If you know any Montenegrins with financial sector background that might be interested, please ask them to apply. Then, of course, review of the statute and business plan MIS, launch of the MIS tender, review and approval of all the policies, the draft guarantee agreement between the fund and the financial institutions, recruitment of staff, all those aspects ultimately to a public launch. We're hoping for December, but because of the fact that there were certain delays in getting the law approved and then the board appointed and everything else, certain things just take time, which you can't rush. One of which is the MIS, which we have the tender already, but we'll launch the tender, and then of course you have to have time for the proposals, and then evaluation of the proposals, ultimately award, and then there's the process. So that takes time. But we're having this as a target, and it probably could go into the first quarter of next year. The legal structure, as I mentioned, it's an independent, autonomous, permanent, self-sustaining, not-for-profit legal entity established by a special purpose law. The law came into effect August 13th. The structure is acceptable to all the financial institutions. It's also been fully endorsed by the Central Bank of Montenegro. A little bit difference from Kosovo to Montenegro. In Kosovo, since the money was being put up, the majority of the initial capital and the working capital was provided by donors and IFIs. There was a little more influence from the donors and MFIs. In the case of Montenegro, in order to get going, the government agreed to put up 100% of the initial capital and the working capital, and therefore felt they needed a little bit more say. So the compromise was that the central bank would draft minimum risk standards and reporting requirements. And I'm very pleased to say that they sent those to us, and we read through them, and we couldn't think of a comma or a period to change. It was exactly what we would have produced anyway, so it's a perfect collaboration. Corporate governance, I've pretty much described. 5 members, 1 from the Ministry of Economic Development, 1 from the Ministry of Finance, and then the 3 independent board members. And as I mentioned, the central bank provided the minimum risk standards. Whoops, here is the, simple org chart. As I said, it'll be very lean to start and by intention. And this is an important point. Like Kosovo, I've been asked in a number of cases over the years to do an evaluation of guarantee funds. And in some cases, the question was, the guarantee fund has a lot of capital. They want to give guarantees, but the guarantees weren't being used. Why? The single biggest cause was that the banks would find a client, they would do all their due diligence, they would decide whether they want to lend or not, they would structure the loan, and they would say, okay, in this loan we need a guarantee, so they would send it to the guarantee fund. And then the guarantee fund would ask for the whole file, the financial statements, the staffing, all the policies and procedures, and then go and visit the client and then do the whole thing over again. And the businesses said, we don't need the money in 3 months, we need the money now. And the bank might have taken a couple weeks, a month, 3 months in the first place, so it gets extended. The guarantee fund had this huge staff, and so they had to charge a lot for the guarantee fees, so they simply weren't being used. So my recommendation was let go 95% of the staff and set it up so that the bank does what banks do, or non-banks or MFIs do. They're licensed, supervised, and examined by the central bank. You have the criteria. They simply submit it for guarantee. You provide the guarantee. So, and lo and behold, suddenly the guarantees get used. Key parameters. As in Kosovo, the law says the maximum leverage of guarantees to capital is 5 to 1. In a minute, I'll sort of give some highlights of what were in the World Bank survey report about that. And so it is 5 to 1 maximum in Montenegro as well. Most of the guarantees will be up to 50%. There will be exceptions for specific cases or sectors. The guarantee agreement is between the financial institutions and the borrowers. The guarantee fund does not interact with the borrowers, period. So they don't interfere with that relationship. There's not conflicts of interest. What the guarantee fund can do is hold workshops or seminars for educational purposes to groups of SMEs, and KCGF, of course, does that. And that can be helpful, but no otherwise direct interaction. This is the basic workflow, and it shows how simple it really is. The SME submits their loan application to the bank. The bank decides whether they want to give them a loan or not. If they want a guarantee, they send the basic information electronically to the guarantee fund. The MIS of the guarantee fund, does it meet the parameters? Yes, it issues the guarantee. It's that simple. And that's why it's very efficient and it can be very lean. So The reason that I finished this presentation at 4 a.m. yesterday, with much chagrin from the KCGF team, was because I wanted to take advantage of having listened to the World Bank global survey of 108 guarantee funds sponsored by the European Association of Guarantee Institutions, and it was actually very informative. Out of 108 guarantee funds, some of which were over 25 years old, but it varied in age, the average leverage is 4.4 times. Now, there was a long tail, as they described it, a long tail of 14% that were up to 20 times. Before KCGF originally, having done our own survey of funds and what we hear from, World Bank and EBRD and EIB and everything else, we decided that a limit of 5 to 1 was a good balance between outreach and risk. KCGF is currently, based on the information I gleaned, is about 1.8 times. And depending on the guarantee window and the donor or the funder or the IFI, they have windows with different leverages. The law is a maximum of 5 to 1, but right now they're about 1.8. Now, part of that is, of course, because they've had increased capital to 104 million now. So, but it shows that they do have headroom to be able to continue to expand. As I said, target in my opinion, is about a 50% guarantee. Almost all of the USAID Development Credit Authority loan portfolio guarantees was a maximum of 50%. Some go up higher. KCGF has some windows that can go up to 80%. But even though you see they have windows that can go higher, the cumulative percentage is 51.4%. So that just gives an indication. Impact evaluation has been discussed today, and Abilena in the morning showed tremendous impact of KCGF, and it's something that Kosovo and KCGF can be very proud of. It turns out of the 108 guarantee fund survey, 53% had absolutely no impact evaluation. So there's no clue to the funders or the government or the financial institutions whether these guarantee funds were actually helping or not. 26% had annual impact evaluation. Well, I'm a little bit of a stalker of KCGF, and I see that KCGF publishes monthly impact reports available to the public on their website. And I think that's excellent because that shows transparency, but it actually shows, are the funds being provided to KCGF helping with SMEs and with the economy. The survey said that 38% of the 108 guarantee funds paid claims in less than 30 days. That meant, of course, that the majority took much longer to pay claims. Again, information I gleaned, just public information on KCGF's website, is that they pay claims roughly in 5 days. That should be very reassuring to the financial institutions that are partners with KCGF. Once you go through the steps that have been agreed in the guarantee agreement and you file a claim, you get paid very quickly. So I think that's very good news. Now the other thing is, the question is, well, banks will put loans, they need a guarantee because maybe it's more risky. There's less collateral, there's less experience. Well, does that mean there's going to be higher defaults and higher claims? Well, you look at KCGF, and if you look at the net claims over the 10-year period, it's 4.6 million. 4.6 million over the 555 guarantees amounts that they put out is only 0.84%. So that shows you that the guarantees increase access to finance, but the actual risk and losses are quite small. So it's very successful. Additionality, I put that KCGF was 27% first-time buyers. But as we heard today, it's 35%. So, which is excellent. But that's misleading. First of all, 35% of the portfolio being to first-time buyers is actually fantastic. That's huge, because first-time buyers are very hard to lend to. I know we lend directly to businesses in several of these countries. The important thing is, and the banks can correct me if I'm wrong, but 35% are first-time borrowers. But most of the other most of the other borrowers might have gotten a loan or a couple of loans. But to grow, and we heard about that in multiple panels today, the question is getting these companies, these micro companies become small to become medium, for them to grow and employ more people and do more exports, okay? So a lot of companies have gotten a loan or several loans, but they need more financing to grow. So they may not be first-time borrowers, but they're still somewhat in a straitjacket. And if the guarantee fund helps unleash more financing to them for them to grow, that's fantastic. We heard today that the average tenor of KCGF loans is now 39 months. Well, it's interesting because there were some questions about Montenegro business plan, how we come up with the numbers. Well, it helps if you've been yourself a lender in a market so that you again understand the context. When we developed the business plan for Kosovo Credit Guarantee Fund 11 years ago, I said the average loan would be about 40,000 euros and the average tenor would be about 35 months. I got very seriously attacked from a lot of different sources. No, the average loan will be much higher, the average tenor will be much longer. Well, okay, the average loan size is 50,000 euros now, but that's also because they have the renewable energy window, which has larger projects, and so it's in the ballpark of what we predicted 11 years ago, and the average tenor is 39 months, which isn't that far off from 35. So it shows that it's important to know the market, who the businesses are, what size the businesses are, what kind of financing they need, and that really helps design the fund and be able to reach to the borrowers that really need it. So I was also asked to talk about the case for regional cooperation. Well, the whole next panel is on regional cooperation. So I think they're going to be able to go into this in detail much better than I will, but just some key points, key things that can be done. One, joint trainings, workshops, and conferences. This one is good because we've got representatives from the region. The Albanian Development Guarantee Foundation is here. KCGF is here. We have, Finland, etc. That's very important. Montenegro, when it comes online, will be a part of this, and we've already agreed to have joint trainings and workshops. Standardizations of policies and procedures, and yes, per the last panel, data is very important, and with all the countries planning on eventually joining the EU, harmonization with the EU is very important. So cooperation and communication between the guarantee funds will be very useful and very important. The membership in the European Association for Guarantee Institutions. By being a member in that association, you get to associate with, I always talk with my hand, you get to really learn from and understand and collaborate with guarantee funds and schemes throughout Europe, which is a great resource in Montenegro Credit Guarantee. Kosovo is already a member. Montenegro Credit Guarantee Fund will, as soon as it's able, also become a member, and that's very important. Then there's cross-border cooperation. So Kosovo Credit Guarantee Fund has an export window to help Kosovo companies export. Well, if a company in Kosovo is exporting, they're exporting to somewhere else. It's another country. Well, the company that's buying that product needs to be able to buy it. They need to have money. So they may need financing for it. Well, if there's a guarantee fund in that country, KCGF can guarantee the export part, the export finance, and the other country can guarantee the financing for the import side. So that's just an example of the ways that there can be cooperation. And one last area is that there could ultimately be created some type of Western Balkan co-guarantee or reinsurance program, such as through the European Investment Bank or things like that, Western Balkans Investment Framework, and that could be expanded and could be very helpful. And the last couple points that are a little bit off the topic, but they were raised here today in the conference, and I'll utilize my 30 years experience in the Western Balkans, 25 years here, to make a couple points. One, there's been a lot of work over the last 15 years for improving the legal and regulatory framework for microfinance institutions. Finally, there is a new draft law for non-bank financial institution, which does include microfinance institutions, and it tries to address a lot of the obstacles that there have been to commercialize the MFIs. Anyway, I just recommend, I think the law is in a very good state in terms of the draft. I recommend continuing consultation and ultimately pushing through to get a final law passed in the interest of helping the entire sector, not only the microfinance institutions, but the MBFIs as well. The last point I'll make, it was discussed about alternative finance, and it was discussed about equity, angel investment, private equity, venture capital investment funds. So I would just like to provide a little bit of a reality check. I'm in favor of creating the legal and regulatory framework for equity investment, including angel investment, private equity, venture capital, corporate venture capital. But here's the reality. The most vibrant, biggest, most successful equity market in the world is the United States. Startups in the United States, less than 1% of startups in the United States get any type of external finance, other than from Uncle Joe or, okay, friends and family and fools, okay? And that includes debt finance. And most of the finance to startups, if they get external finance, which is less than 1%, is debt finance. So yes, a lot of equity in the U.S., but startups do not get it. The exception proves the rule. So, if 1/3% of startups in the U.S. get equity finance, how does that translate to a country that's, instead of being 335 million, is 1.6 million? So that's not to say don't look at it and create the framework and encourage it, but you have to be realistic. The other thing is, the average size, 90+% of companies in Kosovo, and when I speak of Kosovo, I'm including North Macedonia, Albania, Montenegro, etc. Over 90% of companies in Kosovo have less than 50,000 euros annual revenues. So equity investors are typically, especially private equity or venture capital, are not looking to invest 5,000 euros. It's just too expensive. The other thing is equity investment. People in most of these countries think, oh yeah, I'll take equity investment, because they think of it as a grant. When they realize how much percent of their company they have to give up, they're going to have somebody that's in their pants for information, and how much the return the equity investors expect. They go say, well, okay, yeah, we'll take the loan. Then there was mentioned about exits. Minority shareholders, doesn't matter how powerful they are, in privately held companies, where's their exit? Who's going to buy their shares? They don't get a return unless they sell their shares. exits are very limited. So I'm being the devil's advocate here. That's not to say to pursue it, but we created an investment fund, a small investment fund in North Macedonia to test it. And I can't tell you how much time we spent in one-on-one meetings, conferences, sales pitches, going through the banks, the accountants, the lawyers, the universities, and it was very hard for us to find 10 companies to invest in with equity. We finally did it, but guess what? Out of the 10 we invested in, which is typical of venture capital, you know, they say you screen 1,000, you narrow it down to a short list of 100, you spend a lot of money doing the due diligence to come down to the 10 out of 1,000, the 10 you invest in, and 5 to 7 are completely bust, a couple sort of survive, and you expect one to be the winner to cover the cost of everything else. So I encourage moving forward with capital markets law and framework. I encourage people to explore equity investment. There are some opportunities, but I think it's important to be realistic and have proper expectations, because that's just the reality. And with that, I conclude, and thank you very much.